I'm joined in the studio by Schroder's Andy Lynch. Andy, thank you for coming in today. Now, you're not actually currently a holder of Adidas. You don't want to be after these figures either.
No.
Are you staying away from consumer in general?
In general, yes, just because the trends we've been talking about for the last year or so of excess leverage, excess debt, and consumers having to rebuild savings, unfortunately is a real headwind for discretionary consumer goods companies. And delightful as a new football shirt is, it has to rank lower in the rankings of what you spend your money on than putting food on the table and keeping the lights on. So they're still staying away from the more discretionary end of consumer spending.
So you don't like Puma either? I mean, it's not an Adidas it's just a general wide.
Yeah, it's not that I particularly want to kick Adidas. It's I think the numbers from them today and from Puma show that life is still pretty difficult. Consumers are still keeping their wallets not as closely shut as they were a year ago, but still, we don't want to be out there spending the cash too aggressively. And because of that, it's going to be very hard to persuade consumers that as the World Cup approaches, actually you have got to go out there and buy the latest replica shirt, the new match ball, and so on.
Now, Andy, we've also had some figures from a whole other host of companies today. Holcim comes to mind. It does seem that actually today they're missing analyst estimates. Are you concerned about the quality of this earnings season?
I think what we can sort of take away from the earnings season is, to my mind, that analysts and indeed fund managers, sort of in January time, were getting a bit too optimistic. It was a new year. Everyone had just about survived 2009, and now it's like, oh, thank goodness that's over. And everyone still thought, oh, well, 2010, things will be a bit better, we can upgrade numbers a bit more. And what the results are showing us is that it's going to be a very long, hard slog. The economy is improving. It's just improving
slowly.
very, very slowly. And I think we all got a bit ahead of ourselves, a bit too optimistic, and that's being reflected now in companies missing estimates. But actually, I think the underlying trend is still positive, but just very slow.
So you're expecting what you call a period of drifting. Does it mean we're going to see a correction? Do you have to hold more cash today than just a couple of months ago?
I think if you having cash on the sidelines is a good strategy, because then I think you'll get opportunities to buy both markets and individual shares when they get overly punished. So being fully invested in a market where one doesn't have conviction, it feels wrong. Having the flexibility to take advantage of opportunities as they arise, and they will arise, is, I think, the right strategy. So have some powder on the sidelines so you can come off the bench and get involved in the game when the time's right.
How much are you looking at Greece to get your cue? Because, of course, the currency markets are practically only looking at Greece. Does the same talk about stocks?
I think what happens with the macro picture in Greece is going to feed across to confidence and to the multiples people clearly want to pay for stocks. And rightly, everyone's looking at Greece and saying, well, what is going to happen? And in a sense, we've moved now from an economics debate to a political debate. Is there political commitment and political will at the Eurozone level to bail out Greece, to keep them in the Euro? Or is there a decision actually to let them go hang? At the end of this discussion, I think there'll be a bailout, whether it's from the EU or the IMF. But sadly, people who own Greek bonds are probably going to lose money as a result of that bailout. You're not going to get 100% back.
Yeah, a word of warning. Andy, thank you so much.
Thank you.
To speak to you as always.